All right, so welcome to week 4. And so because we only have an 11-week semester, we're almost at halfway. You're past a third of the way through. Scary? Not scary? All right. So today we're going to look at evidence. And evidence is this idea that we need to have proof to support any sort of decision that we make. All right? And we could do this if we're looking to buy a new car, trying to figure out what holiday destination or hotel we want to stay at. We collect evidence. I'm going to do the concept map. All right? So the concept map sort of tells us where we've been and also where we're going. All right, so let me write up here, concept map. Okay, so far, we know a whole lot of stuff. We know that there's the audit report that is generated. And the audit report is about whether we think the financial statements are fairly presented. Okay? I know that I have my legal liability as a result of my audit report. All right? And that liability comes in 3 different formats. It comes in the form of regulation and legislation. It comes in the form of contract law, and it comes in the form of the tort of negligence. And we looked a lot in previous weeks about what that means. Okay. Now, to have our contract law, we also have our engagement letter, which is ASA 210, which is essentially, can't spell today, ASA 210, and our engagement letter is essentially our contract for the audit. All right. Now, I also know that I'm looking for free from material misstatement. That's my audit report. And that I know that materiality is this idea about things that are important or relevant. We're going to look at a little bit later how we actually figure that out. Okay. We know that we have, to figure out what's free from material misstatement, we have our assertions. And our assertions fall into different categories. We have our transaction assertions, which are occurrence. Anyone name another one? Accuracy. Completeness. Cutoff, classification, and, oh no, is that all? Yes, that's all of them, okay. So we have our assertions there for our transactions, and then our balance assertions, existence, what else? Valuation and allocation, rights and obligations, and completeness, yes. Okay, oops, let's shrink that down. All right, so I'm going to start drawing some lines here. Okay, so we have our audit report. I'll make that line a bit thicker. That audit report exposes us to our legal liability, which comes out of those 3 areas. Our contract law comes from our engagement letter. All right. The engagement letter also sets out our responsibilities, but we want to make sure that the audit report is free from material misstatements for it to be unqualified. We learnt about the idea of materiality, and we learnt about the idea that free from material misstatement means that things must meet our assertions. Okay? All right. Today what we're going to do is we're actually going to start to unpack the how we determine whether a sale really did occur, is accurately recorded in the correct period, all of the sales are recorded in the correct journal entries. So today we're really getting into the how, which is the idea of evidence. All right, how do I collect it? Because one thing that we also talked about last week is that I have something called an audit program. And my audit program is my plan to make sure that I gather evidence on all of my assertions. And then that also links through to materiality. All right, so you might notice that this diagram is getting more complicated each week, to the point where by the time we get to week 11, you'll be amazed at how much information we've managed to cover. Okay, so let's go to today's learning objectives. I'll just change my highlighter colour. All right. So we're going to look at analytical procedures, and we're going to look at some statistical techniques, and then we're also going to do some examples. Okay, so this is where, if up until this point you thought, I'm not a very creative type, this is where we need your creativity. Okay, so this is going to be really important to being able to generate our audit programs. Okay, so let's look at audit evidence compared to what they do in other professions. So this is from ASA 200, and it says there, I must obtain, let me turn my highlighter on, I must obtain reasonable assurance, which we already know about. I need to collect sufficient and appropriate audit evidence. Remember, sufficient is about volume and appropriate is about the right amount. To reduce audit risk to an acceptably low level, and then enable the auditor to draw reasonable conclusions for our opinion. All right, so the idea, we have to generate evidence or gather evidence to generate our opinions. So if we look at other areas, and we look at the nature of evidence, and this also comes out of, I think, I didn't put the reference in here. I'm pretty sure this comes out of ASA 500, but I will have to double check for you. So it says here that the audit evidence is necessary to support our opinion. It is cumulative in nature, and it is obtained from audit procedures performed during the course of our audit. So today we're going to learn about what those sorts of procedures might be. It could include information about the previous audit, and there might be sources inside and outside the firm. It could be the accounting records. All right, it could be information from an expert, potentially. And we have information that supports and corroborates management's assertions, and also sometimes information that might contradict. And so that contradictory information for us is often an indicator of a misstatement. All right, an error that we might have. So you might find evidence that supports what management is saying in some areas, but evidence that shows that they're not quite doing the right thing in others. Okay, so I have to collect evidence. There's no getting around collecting evidence. I can't say, oh, I couldn't find any, or it was too expensive, or it's too hard to get. You must collect evidence. And the collection of evidence is not solely related just to auditors. Your police do it if they're deciding to charge somebody with a crime. They have their areas of evidence. Scientists collect it to prove or disprove theories. Solicitors in terms of defending people. Even historians, if we're trying to figure out who studied Latin. Did anybody study Latin in high school? And there's those books about Pompeii. And there's like the family with the dog. Obviously, to be able to come up with these ideas of how history happened, they need to collect evidence. My son's currently obsessed with dinosaurs. And so, he's like, well, Mummy, how do I know that's what a dinosaur looked like? I say, well, we look at the skeletons. We cannot guarantee that how dinosaurs are skinned are actually what it was back there, because we've only got bones to go on. But the bones give us an idea of size. You might have eggs that indicate that some dinosaurs laid eggs. But this is how my son thought that dinosaurs were related to Easter. Because we looked at dinosaurs came from eggs. Chickens come from eggs. Rabbits collect eggs at Easter. Therefore, dinosaurs are also related to Easter. It all came from the idea of the egg. But we didn't know that dinosaurs laid eggs until they'd found eggs to say, well, this is how dinosaurs are born. So We look at evidence in everything that we do. You might look at reviews. If you're trying to figure out a fancy restaurant to take your partner for a special occasion, you might look at buying a new phone, a new camera. You look at online information, reviews online. So we collect evidence every day about all sorts of things to make all sorts of judgments. Some of them easy judgments about where do I want to go for lunch. Some of them complicated judgments about where should I buy my first home, which city should I move to, which graduate job will I go and apply for, especially for graduate jobs, right? You do a lot of research looking into companies. So what are the 4 evidence decisions that we need to create our audit program? And remember, my program is my method by which I'm going to collect my evidence, all right? So this audit program is going to give me evidence upon which I'm going to base my opinion. Oops, I forgot the part of the end. So what sort of decisions do we need to consider? When I'm designing my audit program, and this is the bit that we actually design, so it's good this semester that we're in the same building as the design faculty and you get to see all those students drawing and cutting and designing things. Unfortunately, designing for audit is nowhere near as glamorous. Just use our brains and pens and pencils. But we have to consider which items to select. Okay, so I'm going to give you some definitions here. The population is generally all of the relevant transactions or items. Okay, so which of those am I going to select? Do I want to select all of them, all sales, which could get a little bit tricky if you're looking at somewhere like Woolworths? Do I want to select some more expensive ones closer to the end of the period? So I need to select which items. And we're going to learn about something later on called sampling. Right. Sampling is a way in which I gather evidence when I don't want to look at all of my transactions or all of my items, but I just want to look at some. So I have to figure out which items to select, and I also need to think about my procedure I'm going to use to select them. Right. So which items, how am I going to gather it, the sample size, and this comes back to that argument of sufficiency. How many? 500, 5,000? And then the timing, which is when. So some things are time specific. What might be something that a company might only do once or twice a year? Inventory counting, or what we call a stock take. So if I'm looking at a 30 June year end for a company, would it make any sense to do a stock take in April? No, because we're looking for a balance at a particular date. So some things are very time specific. So my audit program is my list of audit procedures for an audit area. Remember last week we looked at our transaction cycles. Yep. And we had the sales and cash receipt cycle, the purchasing and cash payment cycle, the inventory and warehousing cycles. So typically we will have programs for areas or parts of areas. You'll have a master program that will have the whole audit. Here's the plan for the whole audit. And then programs for individual transaction cycles. And those programs are very detailed. They tell you exactly what to collect, when to collect it, and how many. But somebody has to design those, and that's where we come in. So we're going to come in and we're going to start looking at how we do this design process. All right, so what might make evidence more or less persuasive? The ASA 500 is our standard on audit evidence. So 200s, the 200, 210, 220, those ASAs are all about setting up the audit, the planning phase. Next week we're going to get into ASA the 300s, which are about evaluating risk at clients. There's nothing really in the 400s, that's a bit of a blank area. And then the 500s are all about collecting audit evidence. The 600s are all about using audit experts, so if we engage somebody else. And then the 700s are all about reporting and opinions. Okay, so today we're mostly going to focus in the 500s, but 500 is the main audit evidence standard, and it says I must collect sufficient and appropriate evidence. Remember, sufficient, whoops, put the pen on, comes down to the volume, and the appropriate means the correct type or forms of evidence. Okay, and this comes from, I'm pretty sure, paragraph 6. It was bad of me not to put the paragraph reference in there. But I want to make sure that my evidence is persuasive. It's reliable, it's something that would convince me, rather than perhaps, if you said, look, Amanda, this week I'm sick. I don't have a doctor's note, but I have a note from my mum. I'd go, oh, I'm not sure that's really persuasive, unless I knew your parent and I knew that, perhaps they don't take any crap. I might not take a letter or a reference from your mum as a really persuasive piece of evidence. But if you've been to see a UTS doctor, for example, I might be more persuaded. And there's a couple of doctors, one within the Prince Centre and I think one on George Street, who we know are dodgy doctors. Like you can walk in there and say you're sick and they'll sign any sort of form that the university needs signing. If you go to see one of those doctors and I look at your application for special consideration, I'm less persuaded because I know that those doctors are not reliable. But if you went to the medical centre up here at the university, I know they're pretty decent at doing their jobs, and so that would be more persuasive. I once had two students who applied for special consideration because they were sick and they missed the exam. Students lived on opposite sides of Sydney. So one lived in St Leonard's and the other one lived East Gardens or something. And both students went to a doctor in Campbelltown to get a medical certificate. And they both had exactly the same thing. And I thought, that's a bit unusual. There's my professional skepticism kicking in, saying, I don't think that these guys were really sick, because if you're really unwell, I'm not sure you're going to travel in the car 40 k's to go to a doctor when there have got to be doctors closer to you. So I actually asked both those students to please explain, and it turns out that they were both not really ill, but they had a friend who was this particular doctor, and that's why they went there. So whenever you apply for special consideration, we are looking at the medical certificates. We are looking at the doctors. We do have a list of ones that we think are more dodgy than others because we're trying to figure out what evidence is persuasive. All right. And there are two things. Number one, is the evidence competent? Is it well prepared? Does it look genuine? So competent, genuine, or authentic. And then sufficiency. So you might have some really great, genuine evidence, but you might only have one piece for 5 million transactions. I'd say that's not enough. So competence means it's relevant to our audit objective. Okay, so if I'm looking at existence of inventory and I want to make sure it's there, I don't want to be looking at contracts with suppliers about when do we own inventory. I want to look at physical items. So it's about matching the right procedure here. So we're going to look at this matching process. Match procedure to assertion. We're going to look at that a little bit today. All right. We need to look at the independence of the provider. Outside evidence is more reliable than inside evidence, which is why when you go for a job, they ask for a reference from quite often an academic member of staff, as well as perhaps somebody that you've worked with. And then we look at the effectiveness of the internal controls. And remember, these are the client's policies and procedures. Oops, didn't all fit that down there. How do we make people behave? How do we set out what they're supposed to do and how they're supposed to do it? If we have good procedures in place, then there's likely to be less mistakes, and that evidence is likely to be more reliable. If there was lots of chance for error, then I might not rely on it. So, invoices generated from a computer, the computer system, a good computer package, are much preferred over a handwritten invoice out of a book, where the person who's doing the writing could make a mistake, potentially. All right. We also look at our direct knowledge, so evidence that I get directly is more competent than indirect evidence, so evidence that might come from somebody else. Qualifications of the individuals providing the evidence, so we're looking at an expert, a well-renowned expert is much better. How we can be objective and whether that is timely. All right. So if you request something from a client and it takes them 6 weeks to get it to you, and it should be a relatively simple document, you think, oh, is that document real, or did they actually have to go out and create it to be able to give it to me? All right, so I'm just going to release the question. Okay, so you have in your Learning Catalytics, oh, and if you're not logged on to Learning Catalytics yet, 344641514 is your session up there. I'm going to maximize this so that we don't see everybody's answers. And when you log on, you'll actually see 5 different items of evidence. And then in the right-hand side, you'll see the boxes 1, 2, 3, 4, 5. So rank most reliable as number 1, least reliable as number 5 of those items that you've got there. From what we can see here, we had to rank them. 1 is most reliable, 5 is least reliable. So most people got the first one, bank statement, the order obtained independently not from the client was ranked number 1. Number 2 was the audit committee meeting minutes, because the audit committee is an independent group of the board, those meeting minutes. So even though they're internal, the board members, the independent members there, we rank that in number 2. Number 3, invoice from the client suppliers, because it's external. Number 4, client issued invoices to customers. So these are internal documents that the client has prepared. And then the last one, verbal discussion with management. All right, so I can... oh, hang on, what did I do just there? Can we see the individual responses? Oh, no, I can't, hang on. Can you give me a graph? No, it won't. Okay, so we went through these from most to least. All right, does anyone have any questions about the ranking? Yes. So the meeting minutes is a tricky one. Who got tripped up on the meeting minutes? And that's a little bit tricky. Because they're minutes by the board, so they have to be officially recorded. The audit committee is independent directors, so there's less incentive for them to manipulate. So if I said this was, a committee that had the CEO and the CFO on it, there's probably a bit more chance to manipulate. And those minutes are official documentation, so that's why they were ranked number 2. They're just minutes of the meeting, but the people at the meeting and the positions that they hold in terms of their independence, they're almost external, give it that extra weight. Yeah. Okay, so I'm just going to flick back to here. All right. So for evidence to be sufficient, remember this is the how much question. And so we're going to, later on in the semester, look at sample sizes and how we figure out when we need to collect more evidence versus when we need to collect less. But let me ask you guys just quickly, if you've got an account that is at higher risk of being misstated, would you collect more or less evidence? More. All right. So generally, increased risk also results in increased sample size as well. All right. So our expectation, if we think that there's going to be more errors, or there are poor internal controls, which would lead to increased risk, we're going to increase our sample. And then we also often look at large dollar value items or items with a high likelihood of misstatement. So accounts that are at greater risk, like intangible assets, for example. There's much more risk around trying to calculate the correct value for intangible assets. So the auditor is likely to focus on those areas. If you've got a company that makes lots of sales, then you might also spend some time looking at the bigger value sales. Because if those are perhaps more likely to result in big commissions to salespeople, then again, they're more likely to be manipulated. So in terms of this table from our textbook, so with our procedures, we need to look at the relevance and reliability. We've looked at all those things. The sample size of sufficiency. And we're going to get to sampling, which comes out of, I'm pretty sure, ASA 560. I'm pretty sure. High cost is not a reason to avoid collecting evidence. If something is very expensive to collect, then the auditor must figure out a way or find some form of alternative. All right. No matter what sort of audit firm you go to, dependent on the individual audit manager that you're working for, the individual audit client, the audit evidence that we collect is going to be different. So even if I have two insurance companies and I'm doing the same tests for sales or for assets or liabilities, the things that I might use to collect evidence are going to be different at those firms because those firms are different. They have different management styles, they have different history, they have different organisational structures, different computer systems, which means that our audit evidence always needs to be customised. Right? Just like a lawyer wouldn't give the same defence for every murderer they represent, they tailor that defence depending on, was it intentional or was it unintentional? What was the weapon used? Could they sell an insanity defence? The auditor also needs to customise their audit relative to what the client is like. We also have to learn, and this is probably the hardest bit from today. So the hardest bit you're going to learn today is this bit, which is about identifying, and I said we're not going to have 8, we're going to have 9 different types of evidence that we use in audit. So these are the ways that I collect evidence, and it says they're types of evidence, but I really like to use the word procedure. These are the procedures we use to collect evidence. So while on CSI they use gunshot residue tests on hands, and they lift fingerprints, and they use DNA, and they've got all of these fancy pieces of equipment to gather their evidence to make their case. Auditors have their own fancy sets of procedures. Unfortunately, there's never any exciting equipment. You really only need your laptop and your brain. There's no, mass spectrometers or special things, but we use these procedures to gather our evidence to support our opinion. So here they are. Physical examination, inspecting stuff. Confirmation, which is the process of confirming something with someone. These are pretty self-explanatory, right, so far? Inspection of documentation, looking at paperwork. Observation, watching people or things. Inquiries of the client, which is asking them questions. Recalculation, which is just mathematics with a calculator. Reperforming, which comes into vouching and tracing. I'm going to talk about those two a little bit later. And then analytical procedures, which is your ratio type stuff. Okay, so before we delve into exactly what those are, I'm going to get you to do another learning Catalytics question. So you've got a number of different types of evidence, match them, you've got descriptions, match them to the type. And there's no duplicates, so you can't use any of them more than once. None? These are all okay? All right. Now, you might notice that in our sample of options there, I didn't include one on vouching or tracing, because I'm going to get to that as a separate procedure because it's much more complicated. So far, a whole lot of people manage to get pretty good, most of these right, from not knowing anything about these procedures except the basic names of them, okay? That's a clue about how tricky designing procedures is. It's not that hard. So the words or the descriptions for the procedures give away a lot of what the procedure is about, except for the ones that are called vouching and tracing, and I'm going to get into those right now. So let's quickly go over these again. So we've got all of our evidence. This is just this diagram from the textbook here. Our auditing standards. So ASA 500 says we have to collect evidence. We get lots of different types of evidence using audit procedures, and then we evaluate these. Oops. We need to evaluate our evidence to be able to form our opinion. All right. And we're going to look at evidence evaluation a lot later. So later on, I'm going to get you to actually do real audit stuff. Most of this stuff now is, outsourced to India or the Philippines, but we're going to go back to basics. So I'm going to teach you the basic stuff, even if in practice you might not be doing a lot of it because it is outsourced. So quickly going through all of our different types: physical inspection, looking at stuff, usually associated with inventory, not so much associated with cash, because companies really don't keep big piles of money in vaults that you would go and count. It's not like Scrooge McDuck, where he dives into the pile of money. So we can't exactly go to the bank and say, look, I'd like to look at Target's cash, please. But inventory is something that we quite often look at. The other thing, not cash, that we would look at is quite often property, plant and equipment. Buildings, machinery, furniture. So it allows us to see what the item is and the quantity. It might help us with condition, especially if I'm looking at some sort of net realisable value for the item. But it won't tell me who owns it. The chair won't go, I'm owned by the university. And it won't tell me the value. Just like this computer cannot say at the end of the day, hey, today was $2.50 worth of depreciation. So instead, we need to use other formats. So physical inspection helps us prove that items really do exist. All right. It might give us some information about condition that might help us feed into valuation, but it won't give us the actual value itself. I might look at a phone manufacturer and in the 80s and the 90s where they had the big brick phones, if they still had those in stock as inventory, I'd say, well, unless these are made into some sort of collectible item, probably might be inventory that could be obsolete and might need to be written off, for example. The confirmation. So typically it's written. So the written confirmation is much more powerful than the oral confirmation from an independent third party about information that the auditor requests. So the most common type of confirmation is the bank confirmation. In the old days, we used to fill out a form at the client and you would send it to the bank. You actually pay a fee. So a bank confirmation actually does cost dollars, but you do it online now. And you'll go to your client, you'll put their details into the bank confirmation website, you'll pay the money, and then the bank will go and they'll gather the information that you request, which is typically how much cash is in the account at the 30th of June, what is the value of liabilities, loans that the company might have at that particular date. And they come in two forms. The first one is a positive. It says return the confirmation no matter what. All right. If I ask the bank, is the bank account, does it have $100,000 in it? If they say yes, they write back and say, yes, this is the amount of the bank account. The negative confirmation is one that we don't really use very much anymore, but it says only respond if the information is incorrect. So if the bank said, yes, bank money's $100,000, if it's correct, we don't send any response back. That has its problems, because what might happen if you send someone a confirmation for something like accounts receivable. Right, you want to confirm that a customer owes a debt. And you send them a letter and you say, well, regardless, please tell us what you think you owe our audit client. And they send the letter back regardless. The negative confirmation says, please only send a letter back if the amount is wrong. Okay, imagine you are a customer of the audit client and you owe $50,000. All right, what if the auditor writes to you and says, you owe $100,000? You're going to write back and say, no, that's too much. I owe less. Right? You've overstated the accounts receivable. So quite often people will write back about an overstatement. But what if you get the letter and you owe 50, but the auditor says, do you owe 35? It'd be like saying the bank writing to you and saying your mortgage is less. I'm not going to complain. The customer won't say anything. They'll just go, oh, yeah, no, that's correct. So the confirmations tend to only be good for overstatements. All right? They're no good for understatements because people, especially for asset confirmations, won't want to say that they owe more than the auditor thinks they do. The problem also with negative confirmations is that companies might move business, move premise. You don't get the confirmation back. You must think it's correct. So it operates on really a false assumption. Right? Companies might move, they might become insolvent, or they might just choose that they don't want to answer. And that's pretty common. So a very, very long time ago when we used to send out confirmations to clients, to customers I should say, for accounts receivable, the average auditor gets less than 10% of their confirmations returned to them. So you have to generate the list of customers, you write them all a letter, you include a self-addressed stamped envelope so they can fill it out and send it back to you without any cost. And that process takes, you give them a week to get it, a week to respond. So after 2 or 3 weeks, if they haven't responded, typically the auditor sends them another letter with the same information. And then again, and after that period of time, 6 weeks has gone by and only 10% of your actual customers have responded. So really, you've only got a very small amount of evidence and it might not be sufficient to base your audit opinion. So the thing with confirmations is that they're only one part of a bigger method of collecting evidence. I'll make sure I link you guys to a video about confirmations. I've got a YouTube video on confirmations. And most firms actually give the auditor the option of opting out of doing confirmations. We do them as a historical artifact. It's sort of like, why do you always do X or confirmations? And an audit partner once told me, because it's historical. We always have done it. So we're always going to keep doing it. But they're not a very efficient way for accounts receivable of collecting evidence. For the bank confirm is still something that everybody does. It's the best way to check what the cash value in that account is. But for accounts receivable, which is what we see down here, we see less and less of confirmations being used for AR. So what sort of information? Cash, accounts receivable, inventory, you might have confirmations for liabilities, but I'll put a little mark next to the ones that are most commonly used. Yes, question?
About the positive.
Yes, positive versus negative.
So when you send the positive one, are you just saying, tell me what you owe me, or are you saying...
You still tell them this is the amount, tell me if it's different. But you could use a positive confirmation. I've seen some auditors say write in the blank, fill in the blank of what you think it is, so that you don't risk the overstatement, understatement issue. But the response rate is pretty terrible. So most firms are now moving away from using confirmations, for accounts receivable anyway. So these are the ones that are sort of the most common forms of confirmations. I've marked those. Now, what about when we have technology? In the old days, we would have looked at paper physical documents. A lot of companies will scan documents, email them to each other. They'll have PDFs or online systems. Then we need to make sure that we analyze the information system appropriately. Who can create a document? Who could change it? Who has access to the back end? So traditionally, people would say, oh, look, computers create more of a risk. They just shift the risk to different places. They shift the places where people manipulate to somewhere different. So evidence is still evidence, whether it's electronic or whether it is on paper. All right, inspecting documents. You'll do lots of this. When I first turned up to an audit, on my very first job, my audit senior, who was in charge of looking after me, gave me a packet of Band-Aids. And I thought, why? Along with a green pen. We'll talk about the green pen a little bit later on. But he gave me a packet of Band-Aids, and I didn't understand what the Band-Aids were for until I got my first paper cut. So as an auditor, we do lots of looking through documents. As much as companies have electronic invoices and they have a lot of e-documents, they still print out a lot of things. They'll say, oh, look, we have this PDF that we create, and then I print out a copy, and then I put it in a file folder. And quite often it's the auditor who will be going through those files. So we have lots of documents of all sorts of things. Pay slips, executive hiring contracts, supplier arrangements, email communication, any form of documentation you could think of in a firm, you're probably going to look at it at some form in the audit. A list of all the assets, the quarterly budget. Documentation can be anything and everything. It can be internal or it can be external. External documents come from outside the client. They're only as reliable as the person who's generating it. So if we get external information like information from a bank, that's pretty reliable because banks are highly regulated and they've got good internal controls. If you get an invoice from a supplier that is a one-person operation and he doesn't use a computer to generate his invoices, he writes them all out by hand, then there might be a little bit less reliability there on those external documents. I'm going to get to vouching, and there'll be a video I'm going to get you to watch. Vouching is when you start at the end of the transaction. So you start with the journal entries. Right, so what happens in a transaction is you normally have a transaction. Oops. There's usually some goods and dollars exchanged. And then you have some sort of journal entry. All right. Vouching is when I start at the end with my journal and I vouch back to proof of the transaction in supporting documents. All right. So vouching is all about going backwards in time. Okay. Tracing, I'll do this in a different colour pen. Tracing is when I go forward. All right. When I start at my transaction and I follow it through to the journal entry. Okay. Vouching going backwards, tracing going forwards. All right. Vouching backwards, tracing forwards. We don't have time to go through, there's a great video where I show you exactly why we have those two different procedures, and I'll set that for homework this week. Observation. Thank you. I usually say it in twos, sometimes threes. I think it's only two. Okay. Observation. Observation is watching people, but observation has its downsides and it's not sufficient on its own. And observation is always something to be careful of because people change when being observed. When they are observed. And I noticed this as a teenager. I'm not very neat. I'm not a neat and tidy person. I'm a bit of a chaotic mess. And when your mum comes into your room and she says, clean up, you start folding properly and you put stuff back where it's supposed to go. And then when she thinks you're doing a good enough job and she walks away, you just open your wardrobe and you just chuck stuff in, right? And you shove and then close the door. And then it looks clean. It's the same when we're observing people doing accounting. Just like when you're sitting in the exam center and the exam supervisor walks towards you, you look down, right? Even if you're just staring at the ceiling, you look down just in case you don't want them to think that you're, copying off someone else. You just look down. So when people are observed, they change their behavior. And they might take a shortcut normally, but when you're watching them, they go, oh, I'm going to do everything by the book. So observation is good, but not the only thing you'd rely on. Talking to the client is good, but you always want to make sure that you back it up or corroborate it with actual evidence, physical evidence. This is the AWA v. Daniels case in which the auditor didn't corroborate management statements with actual evidence. Recalculation, so this is the mathematics, all right? Anything to do with dollars and maths is our recalculation. Reperformance, and we got into the vouching versus tracing bit. Analytical procedures, anything to do with ratios or trends. I'm just going to change my pen colour here. Ratios or trends is to do with our analytical procedures. So just like the stuff that you do in financial statement analysis, where you're comparing current ratios per firms, looking for something unusual. So here are all the different types of evidence and the situations in which they are good and not good. You can watch those. And the terms, look, this diagram here, I don't tend to use these terms. I just describe stuff using the procedures, right? Oh, I want to check the existence of inventory. Well, I'm going to observe a stock take, or I'm going to physically inspect the assets and perform a stock take myself. So don't get too caught up on these sort of words here. Not too fussed about it for you guys. The same with this. So what's the purpose of analytical procedures? To look for relationships or trends, right? We know about accounting. We know how accounting works, and therefore, when you make some journal entries or transactions, other things are implied. So for example, you go debit cash and you go credit revenue, autocorrect, okay? You have this journal entry here. If you're selling a real good, what is the other journal entry that'll have to happen? Debit, cost of goods sold, credit inventory. All right, so you know that these two journal entries go together. So if you see revenue go up by 10%, then what should happen to cost of goods sold? Also up by 10%. But what if, instead of that, you saw revenue up 10%, cost of goods sold up 2%? What could be going on? You could have fake sales. You could have a failure to record COGS. You could have some economies of scale, and that makes inventory cheaper. You could have changed suppliers. All right, so the idea of APs is to look for things that you expect to see, and then when you see something different, that's like a flag that says, hey, shine the light right here. Here's something that could be unusual. Just like if you have a company that's making lots and lots of sales, but inventory turnover is slowing down. You think, oh, okay, we're making more sales, but turnover is less of inventory. What could be happening there? So this is all about highlighting areas of concern. An analytical procedure will not say this salesperson was making fake sales, but it will say this is the area to investigate. So this is like the little spotlight or the torch for us. All right. We do analytical procedures. We're going to learn about doing them mostly at the planning phase. So this is for identifying areas of risk. At the testing phase, we'll be able to do some, do you remember doing variance analysis and inventory calculations for cost of goods sold and inventory valuations? So that's in the testing. And then at the completion phase, we come back and we do the same analytical procedures we did at the beginning. Because if I find the funky thing that was going on with sales and I adjust it in the accounts, then that funny ratio shouldn't pop up again. Okay? All right. We're not going to worry about learning about the 5 major types. Really, you guys mostly do ratio analysis and common size trends. So percentage change from last year and ratios, just like you do in FSA, is exactly what we're going to be doing in auditing. Because we're not going to do this idea of auditors actually doing regression analysis is less common. All right, so from business stats, you might remember doing regressions, but there's less chance of that happening these days. And there's all sorts of fancy software that firms use, but it starts with Excel. All right, this is not in the textbook, but I wanted to make sure I talked about it before we leave today. Big data. So you might have heard the words data science or big data bandied about a lot. Auditors can use computers and large volumes of data to their advantage by using a computer to test all sales transactions or all inventory transactions with the correct programming from the audit firm. Even your analytics, it could do things matching salespeople and sales returns or commissions or unusual behaviour. So there's a lot going on in the area of analytics. Ernst & Young is probably leading the way in terms of big data and use within audits. But there are some hurdles, skill sets. So if you've not done any analytics work and you've got some electives, might be something worth looking into, because the skill sets of auditors in relation to big data is fairly limited, but there is a lot of demand. They do rely on a lot of algorithms and programming. So like any computer system, it's only as good as the programming, which is why auditors with the right skills are important. And there's not a lot of standards. There's nothing about how we might use big data to our advantage. Could there be ethical implications for us or for our clients? Now, I'm out of time to do some examples, but I will generate some examples and I'll make a video and I'll pop it online for you. Can I get somebody to give me a company that I can use to generate my example? Company. And what do they do? Oh, okay, all right. So I've got some companies. If you've got any others, send me the links. I will generate some examples on these and I will add these to the lecture video. Okay, so now I'm going to do an example of generating some procedures based on a company that we all know. So I'm going to choose Apple. I'm doing this on an Apple iPad, so let's have all these there. So let's look at something like sales for Apple. And we know that if I'm looking at sales, then we have particular account management assertions to think of. So we have occurrence, oops, can't spell. We have accuracy. We've got completeness. We've got cutoff. Let me just adjust that. Trying to fix the spacing on these so we've got enough room. And we have classification. All right, and those are our assertions that come out of ASA 315, paragraph 1A128. Okay, so let's go through each of those. So if I'm trying to prove that sales really did occur, I want to probably do some form of vouching. Now let me just change coloured pens here. All right, so if I'm testing occurrence, I want to vouch. So vouch my sales journal entries to proof of delivery to customer. All right, because that's when our revenue is recognised. Our revenue is really recognised when our goods go to the customer. If I was going to do accuracy, I could recalculate invoices or receipts with published price lists to ensure that the amount we charged our customers was correct. Completeness is the tough one, but with completeness I usually use tracing, so I could trace orders made by customers to proof of delivery, journal entry, or let's say cash receipt, payment receipt, and journal entry. And that way, I know that if any orders don't have proof of delivery, for example, then I might be missing some part of the transaction. Cut-off is going to apply to goods sold around the end of the financial year. So I might say around the end of financial year, check sales to ensure goods were delivered on or before the end of financial year. That could be June or it could be December. And then our last one, classification. We want to make sure that our accounts go to the right journal entries. So check from sample of journal entries and ensure correct account code from our master chart of accounts was used. Now these procedures are going to be different for different sorts of firms. So we've done this for sales for Apple, but if I was doing sales for a different firm, let's say we were doing this for Coca-Cola, then we would have a different set of procedures because they sell perhaps in different ways, they have different risks, different accounting issues. So our examples are always going to be different, but this is just me generating some examples on the fly. I'll make sure that I link through to some YouTube videos where I do this for other companies and other sorts of accounts. But this is where it's important for you guys as accountants to think creatively. This is where auditing really comes into the idea of being an art form rather than a black and white issue. So creativity is the key here. So I hope you've enjoyed the lecture, and I look forward to seeing you all next time.